A very good afternoon, everyone. Through our multiple editions of Netra, we have talked about several narratives. Some we have backed with data, and others we have challenged also with data. In this edition, we turn to one of the most widely held narratives: how fast is the US debt situation deteriorating, or is it even deteriorating? And along with it, the fate of dollar, or as we have called it, the king dollar. The question we answer here: will it continue to reign as it has so far? Next, we shift focus to India, zooming out for the big picture and zooming in to see what's really happening on the ground. And finally, in our last section, we talk about valuations. We see why the worst might still not be behind us, and though the markets continue to look frothy, which are those pockets where we could still find some respite. To answer all these questions and give you a much more nuanced perspective on each one of these, I will have Sahil take over. But before we begin, a quick note: you will have a question answer tab on your screens. Feel free to post your questions during the course of the presentation. We will take them collectively towards the end. Over to you, Sahil.
Thank you, Pragati, and thank you all of you for joining this session of DSP Netra. And in this session, we are going to be particularly talking about all the topics that Pragati highlighted. So we'll straight away jump into the presentation. The deck is available online. You can, of course, read it as we go along. It is there on the DSP website, dspim.com. There you will find this deck. So in this edition, the first section is about King Dollar. First, we'll take a look at the US debt situation, how it has moved. There is a narrative in the market or expectation, which has partly also, been true for some time, that US debt situation has become worse over a long period of time, and specifically after COVID. And this exact problem that US debt is facing is at the federal debt level. So, what are some of the numbers that I'll tell you? What is the problem that has been in the market and a lot of people have spoken about? So, you would have seen this, statement being made repeatedly that almost 50 or 60% of the all US dollars which have ever been printed were printed after COVID, right? It's a fact. So I'll give you some numbers. For example, from 2008, in 2008, US debt or the federal debt in United States was about $11 trillion, and US GDP was about $14 trillion. So 11 and 14, US federal government debt or the sovereign debt. So the word that we use in India was $11 trillion. That number today is about $38 trillion, the latest number. So, for example, the US GDP in the same time has gone from 14 to 31. So, debt has gone from 11 to 38. GDP has gone from 14 to 31. So, you can see GDP added about $17 trillion overall, while debt added about $27 trillion in totality, right? So, this accelerated increase that we have seen, out of this about additional 27 trillion that US added, more than 20 trillion was added in the last 5 to 6 years. And that has been the big problem, correctly highlighted over a period of time, that US federal debt has gone up significantly. And that is one of the reasons why a lot of people have been writing off the US dollar. And the second reason for, you know, lack of conviction about the US dollar and the financial system stems also from the fact that interest rates in US, which were close to 0% after COVID, um, and also after global financial crisis of 2008. So between 2008 to 2020, US rates hardly went up to about 2.5% when Fed raised them in 2018. Almost all the time they were very close to 0%, 0 to 50 basis points. So for elongated period of time. And therefore the interest rate burden on the debt was very low because they were not repaying anything significant. Most of the debt was borrowed at between 0 to 1 or 2 or 3%. So the interest rate burden was not very high. The moment the Fed increased interest rates in 2022-23, the debt burden significantly shot up. So much so that now US is paying about $1 trillion annually in debt repayment. So all these are facts and they are very important, and we have highlighted them in various previous editions of Netra. And these are the facts because of which there was a lack of confidence in United States economy or the dollar, and a lot of people, including central banks, started to shift away to other assets, particularly gold. A lot of people missed that rally. They were found wanting. Over a period of time, gold prices went up, and that just in the last 3 to 4 months, people have woken up to this fact that a lot of central banks were buying gold instead of the U.S. Treasury, and therefore gold prices went up. So this is the brief background of how the US debt problem came into force. But let's take a pause and look at the country as a whole, United States as a whole. When you look at the country, there are three main actors, three agents of the economy. One is the government at the federal level, at the state level, and the municipal level. But it's the government, right? The government of the United States, you can club it together. But in this chart, we have put them under two heads. One is the federal government. In India, it is called the central government, and then the state and municipal and local government has been clubbed together. Second is the non-financial corporate businesses. Why have we not taken banks? Because banks are the ones which give the loan. So we don't want to take them again borrowing because it will amount to double borrowing, right? So we will not take them. That's why only non-financial corporate businesses, which is the corporate debt. Third is the households. How much are households borrowing? Households are people borrowing for themselves for how mortgages or housing loan or car loans or personal loans, etc. So, or credit cards. So when you put all these numbers together, in July 2009, just after the global financial crisis, when the Fed had given a huge quantitative easing, and for almost 8 to 10 years, US households were borrowing huge sums of money. They were increasing their balance sheet size to buy homes. Their credit card debt was through the roof. And people who have lived through that time will know that there was a huge household spending in United States at that point in time. So balance sheets of households and corporates were deteriorating at a very fast rate. But the federal balance sheet was more or less okay. It did not deteriorate so much. It was more or less flattish. You can see that. I will try to highlight that here, right? So if you look at this phase here, this gray phase, you will find that the federal debt was more or less flat in conjunction to the GDP, while household and corporate debt went up significantly. But what is surprising is that in 2009 July, debt as a percentage of GDP, when you add all the four agents of the economy, which is the federal government, local government, corporate, and households, the total credit to non-financial sector. You can't call it total debt because there is also borrowing in between these entities. So the total, you can call this economic leverage, right? So total credit to non-financial sector is what it is called in economics, was 250% of GDP in 2009. And this number zoomed significantly to 293% of GDP just after COVID because there was a massive stimulus which the US government enacted. Federal jump, federal debt jumped significantly, household debt jumped significantly. And this is the problem point that a lot of commentators, including us, have discussed over the last few years that debt situation really deteriorated, which I just gave you the brief at the beginning, right? The debt went up, interest rates then followed, and then burden became very heavy. But what is not noted properly is what is the total economic leverage and how it has changed. So if you look very closely, debt as a percentage of GDP was 250% in 2009, was 252% just before COVID, January 2020, went up to 293, is now back to 246%, which is lower than July 2009 level, right? Which means that when we say that US economy has become more indebted, that probably is a half truth. Why? Because the US economy is actually at the same level it was prior to COVID and in fact post global financial crisis. It has not deteriorated significantly. What has deteriorated is only the federal debt. So at the economy level, I think the economy is still it is still there where it was earlier. In fact, when you compare the same number with other countries, for example, you take Eurozone countries or a China, or in fact, even India. In India's case, I think corporate sector has delevered, so you'll not find a significant difference. But in most countries, this number is actually worse off than United States when you add all the four agents of the economy. And therefore, at the country level, the number is more or less important for US. It has actually improved. Now, why are we taking debt to GDP? Okay, why not absolute numbers? You can take absolute number, but absolute numbers will not tell you the full picture. Even in terms of absolute number, I'll tell you a very startling figure. If you listen carefully, you will remember that number. I told you that US federal debt has gone from 11 trillion to 38 trillion today. So an addition of $27 trillion totality. In the same time, the US household debt has increased by about 7 trillion roughly, and the corporate debt has increased by about 6 trillion. So in absolute terms, while federal debt went up by $27 trillion, the other two entities increased by $13 trillion. So that is a big difference. And why this difference is important? Because households and corporate businesses are much larger than the federal government in terms of their economic impact. And therefore, they adding low amounts of debt or lesser amounts of debt is also important. And at the same time, in this whole cycle, the GDP went up by 17 trillion, which means that households and corporate businesses have actually delevered, which means that for the same amount of economic activity generated, they took lesser debt, which means that they are taking less and less debt. There are many reasons for it. For example, the global financial crisis in 2008 caused a big hole in US household balance sheet. People became more fearful. They wanted stronger balance sheets. They took lesser number of loans, specifically housing loans, and therefore this position improved significantly. And for US corporate businesses, most likely the core sectors took a backseat and less capital intensive technology sector took the front seat. And therefore, corporate businesses did not need leverage and therefore they delivered. So, on the whole, you can see I've put down these numbers in 2008. The purple bar that you see, US federal debt to GDP was 80%. It went to 119 now in April 25. But look at the numbers for household debt, which was 100% of GDP, um, is now 69%. Corporate debt, which was 47% of GDP, is 46%, hasn't moved at all, right? So you can see the big difference which has happened is US government raising the federal debt. Why it has happened? There are two very specific reasons. The GFC, global financial crisis, completely broke the back of households and also a large number of businesses, right? Very few highly profitable technology businesses in US did very well, but rest of the businesses could not do so well in United States. So in order to prop up the economy, the federal government, including the Federal Reserve, which is the central bank of United States, both of them enacted very high degree of economic stimulus for all these years, and that is the reason why the federal debt has gone up significantly. You can also add in a bit of politics here, because once politicians understood that you can borrow as much as you want, specifically because you have the US dollar, they exploited that loophole and kept on borrowing and spending money, which even the current administration is continuing, right? But when you look at it from a distance, what is happening at a country level? You can, if you look at this chart, the federal debt, of course, has gone up significantly, but as I said, both households and corporate businesses have delevered. So the total economic leverage on the economy has actually come down, not gone up. And therefore, when we talk about the US dollar and we talk only about the federal government, we are missing the other two large players of the economy. And these two large players are very, very important. For example, let me give you a more local, nuance to this subject. For example, let's assume that government of India runs a very large fiscal deficit. It is actually running a large fiscal deficit at 4.5% of GDP. Our current account deficit also moves quite a lot, which causes the rupee to depreciate or appreciate. Now think about our private sector. Because Indian IT sector generates a huge amount of surplus, and now global capability centers are adding a lot of dollar inflows to India, it balances out the weakness in the uh, central government balance sheet, right? With the inflows that the private sector brings in, or the strength of the private sector balance sheet cancels out the negative impact of the balance sheet stress anywhere else, right? Similarly, that happens in the United States also, right? And when we talk only about the federal government, we miss the other two main characters in the US economy. And therefore, when you look at it from a distance, you zoom out and see the situation, it may not be so dire as much as the commentary is suggesting. And also, the offshoot of all this hypothesis, which I presented at the beginning, where interest service burden has gone up, plus debt in US has gone up, other central banks are buying gold. Uh, and when you hear these three facts, most commentators will stop here, right? They will not question why. Why is it happening, right? First question is why other central banks are not buying US Treasury. Generally, the answer is given that they don't like it. They think that US will not last, or the US dollar is going down, or the term is used de-dollarization. But the data tells you something very, very different. What does the data tell you? First, let's look at the data. So this is the data where the narrative that supports that other central banks are not buying dollars is clearly shown here. I will just mark it here. You can see this blue line here. It has been flat from about 2013-14. This is the foreign official holders of US Treasury, right? So whenever somebody wants to buy US dollar, they don't buy the physical greenback. They don't buy the green color notes, right? They actually buy the US Treasury, which is the US Treasury bonds. So they are not buying. Who are these foreign official holders? Largely the foreign central banks, right? Their holdings have not increased. Now this is a very simple fact, and you can paint it any which ways. And a lot of people will stop here. The next question is why have they not increased, right? And there are two answers to it. They don't like it, which means that they don't want to buy the dollar. Second is maybe they can't buy. Okay, I will come to the second question later, but let's look at the first answer, that they don't like the dollar, right? Then what do they like? Okay, what do they like? What is the answer? Now, a lot of people will say they like gold, right? And that's why gold prices have gone up. But if you look at it very carefully, gold prices have gone up only in the last 18 months, from Feb 24 to now. Before that, for 8 years, when central banks, for example, if this answer is true, if they like gold, prices were actually flat or falling, they were not rising, which means that this hypothesis isn't correct, right? Or maybe it is partly correct, not fully correct. Maybe then let's look at the second answer. The second answer was maybe they can't buy US Treasury. Why they can't buy US Treasury? Now this is very interesting because most buyers of US Treasury comes from emerging markets and Japan. Most US Treasury holders are the top Treasury holders are China, Japan. UK is also a large holder now because it has replaced others. Then there is India and other emerging markets. The simple fact of the matter is any country which has a large trade surplus with United States and earns a lot of dollars, they want to park those dollars in US Treasury, right? And that is how US gets reflationary, or they get rebuild or relent the same amount of money that it is printing, right? But what has happened after 2013-14? Most emerging markets have not been receiving the kind of dollar inflow that they should have. And the reason, US produced its own oil or shale oil and stopped importing oil. So a lot of oil producing countries which were getting a huge orders of oil from United States stopped getting it, right? And therefore that surplus which was flowing to a lot of emerging markets, Saudi Arabian, Middle Eastern countries and some Asian countries, it stopped completely. A lot of it flowed to China, and if you look very closely, Chinese FX reserves, which were $3.1 trillion in 2012, are still $3.2 trillion or $3.3 trillion after almost 13 years. Why? Because all the trade surplus that you see in China is seeing outflows from capital account. A lot of people have been sending money out. So China ends up with nothing to invest. So it is very easy to paint a picture saying that central banks have gone against the US, and you can create a conspiracy theory also. But when you look at the data carefully, these central banks don't have enough reserves to invest. And the larger ones, China being the key, and other oil exporting countries also being the key. Saudi Arabia has a very large FX reserve. Russia had a very large FX reserve, which also got wiped out, right? They are not able to buy US Treasury because they don't have the resources. Which other parties have the resources? Which is again a very interesting part of this conversation, where the foreign private holders come in. These are the private entities, private institution, investment funds, pension funds, hedge funds, mutual funds, individuals, high net worth individuals. All these people have been buying dollar and their demand has been going up exponentially. Now think about it, that why do these people like the dollar, or why do these people like the US Treasury? Do they not have the same amount of lack of confidence that central bankers have? Are the questions that central banks have in their mind different from what institutions have? Why would this number go up if at a broader country level there is a lack of confidence in the US dollar, right? Now, it is partly explained by what is called as a basis trade, where the position size is now about $1 trillion, but this number is much higher than $1 trillion. This number is around 5.2 trillion as reported, and when you count the euro dollar market, it will be as high as $10 trillion, which is a very very large number. So when you put all these hypotheses together and look at the table at the right, it shows you that US Treasury currently offers one of the most attractive real interest rates. It makes a lot of sense to put all these data together and tell that US at a country level is not more indebted than it was just prior to COVID. It is at the same level. Is that level very, very conducive? No, 250% of GDP is not a very exciting level. But the question is, were we asking this question in 2019? Most likely no, right? Are we asking the same question today? Yeah. But has the data deteriorated? It has actually improved, right? It has not deteriorated. So, second thing is that economic leverage of the whole country decides the fate of the currency more than any single entity, right? Can a single entity cause trouble? Yes, of course, it can cause trouble. For example, if there is a breakdown of the Federal Reserve System because of an auction going bad and US dollar suffering a lot, it can have repercussions. But when you look at the data in totality, it does seem that the overall situation is not alarming. Third is, uh, can dollar make a comeback? And I have used, or we have used the phrase king dollar. What does the king dollar mean? Dollar continues to be the only globally accepted legal tender currency. There is no competition as of today. If you take any other currency note to any other country uh, versus a US dollar will reign supreme. It is accepted globally. Even if nations don't want to trade in US dollar, they still end up trading in US dollar, because if they don't trade in the US dollar, their recipient will trade, or they will go and save in US dollar or US dollar denominated assets. Why is it so clear? For example, if you don't want to buy US Treasury, if you want to expose yourself to the stock market, you end up buying the US stocks because they comprise almost 50 to 60% of the world market cap, right? So, by any way or means, if you want to expose yourself, you will end up exposing yourself to US dollar assets. And therefore, the phrase king dollar, that it continues to remain the only legal tender. And we believe that recently dollar went to 96. When you were writing and researching this article, it was hovering between 97 to 98. Recently, it has gone to maybe 100, the DXY index. We have no idea where the index will head, whether it will head to 110 or it will head to 90. But it does appear that the reasons for the dollar depreciation, which looked so clear or so, consensus reasons, they actually are not very, very significant. That reasoning appear to be slightly hollow. And we believe that when the market recognizes these numbers, there will probably be a more stronger dollar, um, and some dollar appreciation that can happen. And if the conditions for dollar appreciations are strong enough, which possibly could be a title or a theme for the next few Netra that we write, it can lead to maybe some outflows from assets which benefit from a falling dollar. For example, hard assets, right? It can also trouble some emerging market currencies which have weak balance sheets. So the conclusion from the first section is that um, our idea is that don't be overly pessimistic or look for a judgment day for US dollar. There can be simple depreciation pressures which happen to any currency. but thinking about devaluation or a crash or a doomsday, I think is slightly more misplaced when you clearly look at the data. And maybe a stronger dollar can have repercussions globally. And we see that as a more or an event which has a higher probability than an event where dollar depreciates significantly. Now we go to the second section, which is India growth. This section is very, very important. We look at a zoom out where we look at multi years of the price trends and growth trends. So what we've taken three markets: China, India, US, the three largest economy in the world on PPP terms. PPP, simply put, is it takes away the price effects and calculates in each country. When you spend based on the purchasing power or based on the cheapness or dearness of specific commodity, it tries to make a like to like comparison. All these numbers are what is called in international dollars, not the US dollar, but an international dollar. You can go and read it. So at this point in time, the current number for China, India, and US is depicted here. So at today, roughly China GDP on a purchasing power parity in international dollars is about 41 trillion. I've just written 40 so that it's easier to remember. It's actually 41. But let's say China is 40, US is 30, it's slightly higher, but 30, and India is 18. So it catches the mind quickly: 40, 30, 18. That is where these three countries are. China biggest, number two US, India is at 18. If they continue to grow at a certain number, we've took some historical extrapolation. Of course, it will not play out this way. But if it does, by 2050, China and India will become much, much larger than where US is, right? Even if the growth rates are slower, even if they are half of what we've taken, they will still overshoot United States growth rate because US growth rates are much lower on a trend basis, right? And therefore, by the time you reach in the next 15 to 20 years, you will see that India and China would have become much larger. In fact, in comparison to 1980, the size of the economy has already become much larger. You can see India and China are now about one fourth of the world, slightly more than that, or about one fourth of the world. They will become a third of the whole world. Now, why are these numbers important? I will show you on the next slide. Um, for the reasons that the total spend becomes much larger. So you get more economic heft, but please don't make any mistake that per capita GDP continues to be one of the most important and fundamental trackers of economic growth, not the total GDP, right? Because per capita GDP makes sure that at a citizen level, the prosperity is reflected. So when I quote these numbers, going to 180 or 140, if these numbers reach that level, the per capita number will also look more respectable, which means that India will become a middle income country, and China will probably knock on the door of high income country when we reach these numbers. In fact, a small note on China. China now has the most perfect ingredient for gaining per capita income. What are the perfect ingredients? A middling growth rate and a declining or plateauing population. If you go back and read economic history, these are the phases where countries become actually rich. They don't become rich at the citizen level just when they are growing. They actually become when the population flattens out. And there is a time period where prosperity actually spreads. And of course, with if population keeps declining, it generally then it becomes worse, right? So it's a much larger, longer cycle. But China has now that special place of the next 10, 15 years where prosperity flows through the citizen because number of new incremental citizens are not going up, right? In case of India, that number will still keep going up in the next 10 or 15 years, and then it will plateau, and then we'll probably hit that number. So now we are in sort of an acceleration phase. Now, why are these total numbers important? With the caveat in mind that per capita number is more important, and we will look at it in the next few issues. But I told you total numbers are also important, and I will show in these two slides. First is that India is now going to spend about $12 trillion on GFCF or fixed asset creation, which is creation of roads, railways, ports, etc., all fixed assets. From 2020 to 2030, we'll spend $12 trillion. We spent 12 trillions from 1947 to 2020. So you can see the difference. Now, why is this happening? Of course, because our size has become bigger, right? It is nothing but size. But there are many countries which never gained this size. They would have also spent maybe 5 trillion from 1950s to today, but they will end up spending much lesser number in the next 10 years because they could not increase the amount of expenditure that they have. Reasons could be any: geography or lack of policy making or pure simple luck. But in case of India, this number is much larger. $12 trillion is a very large number, and it will make sure that this spend cannot be ignored, neither domestically nor internationally. Why cannot be not ignored? Because when you look at the expenditure profile, 1 rupee spent or $1 spent in each country has a very different impact. So, for example, when you look at $1 million spent on making the same road, same quality road, here we've taken 1 kilometer of rural road constructed in United States and China and India of the same quality. Okay, of the same quality. When you look at this data, you will find that India creates 6 to 7 times more road infrastructure for the same $1 million spent. Now, how is this possible? Because the cost of inputs in India is much more cheaper. The cost of policy making in India is much more cheaper. I have highlighted it through 5 points here: land and right of way, standardization and specifications, labor and local inputs and wage levels, regulatory and time cost, and urban complexity. You can read that here. By urban complexity, it means complexity in all areas, not only in urban areas. What does this mean? That it is much more tougher cost wise to construct the same amount of road in US, much more easier in China, and the easiest in India. So now when you go back and see the previous chart, $12 trillion being spent, it makes a big difference. If you spend that same money in United States, the bang for the buck is smaller. If you spend that same money in India, the bang for buck is much larger. And therefore, when you compare these numbers, you will see that the size or the scale advantage that we will gain in the next 10 to 15 years will be remarkably high. And this can be a very important input to our investment rationale whenever we make those rationales, right? Third is we take a zoom in view. So zoom out, we saw that growth rate looks very, very spectacular. They appear very strong. Of course, the rate of growth, of course, has slowed down, even in the last two charts. When I tell you the absolute numbers, they sound very jazzy, they sound very good, but the rate of growth, which means that earlier, if we were growing at 8 to 8.5%, for GFCF, now we are growing at about 6% or so. So the rate of growth has slowed. Even then, the numbers are much stronger. But when you look at a zoom in to the high frequency indicators, you can see that there is a clear distinction. In the last 10, 12 years, our growth rates have actually slowed down. If you take any segment, personal loans, petroleum consumption, they went up post COVID. They are back to their worst level over the last 4 or 5 years. And even when you split the economy in this decade between 2001 to 2013, why 2013? Because 2013 is where we had twin balance sheet problems. We also had different policy making. When the new government came in, it changed the policy. So a lot more was expected and is expected. And you can see the growth rate has actually slowed down. It also is a function of a bigger base, but nonetheless, you expect that uh, with stronger policy response, probably the economy will react positively, but that hasn't happened. When you look at indicator by indicator, the numbers are quite so slow. So, for example, when you look at the automobile sector, there are a lot of sections within two-wheeler, three-wheeler, four-wheeler space where, for example, X of SUV, 10-year growth rates are less than 1 or 2%, right? So these numbers are not very exciting, and they tell you that at a more short-term level, growth has actually slowed down. Maybe there can be more, let's say, policy responses where growth picks up. But as of now, most of those policy responses are absent. What can be those policy responses? Larger government expenditure. Currently, it is absent. Although we are running a very high fiscal deficit, incrementally every year we are reducing it. B, our interest rates continue to be quite high compared to where the growth rate is and where the inflation is. That policy response is still pending. And third, and the most important of all, is that the corporate sector in India is yet to embark on a Capex cycle. It continues to be in a slow lane, and the reasons are not very clear. Maybe the demand itself is a reason, so it becomes a chicken and egg scenario, but that continues to be a problem for growth rate to pick up. So when you zoom out, the picture is encouraging, but when you zoom in, you have to be a little more sober in your assessment, where growth is not picking up at a fast clip, at least in the short term. The third section is on valuation and the IT sector. So first is that we looked at the broader market and we, decided to look at the price to earnings multiple for different companies and also the average return on equity in that bucket. So we divided the PE multiple in the increments of 10. So 0 to 10, 10 to 20, 20 to 30, you can see there. So if you look at it, the bulk of companies lie between, 30 to whatever, 60 times or higher multiple. Almost two-thirds or 60% of the companies have a multiple which is higher than 30 times. And ROEs have also deteriorated in that segment. Where ROEs are higher, the multiples are lower. So, which means that some high quality businesses are still available in the market, but broadly, the market, you will find it tougher to, find bargain opportunities in the market. Second is we compared the last year market high to this year number, and you can see that between September to now, markets have not done anything great. They have largely went down, then went back up. The price returns are flattish to slightly negative, but you can see price to earnings multiple hasn't really gone down, just down about 100 basis points. Price to book hasn't fallen significantly, although there is some reduction. Earnings yield hasn't improved only by 20 basis points. Return on equity has actually worsened. Similarly, forward multiples have also not gone down significantly, which means that earnings growth has not improved. In fact, sales growth and earning growth both are same or has deteriorated from the numbers that we had earlier. And other technical indicators have also been in line or they become worse. So that tells you that although the market has spent considerable amount of time, about 12 months or more, at similar levels, but from a pricing perspective or valuation perspective, things haven't improved yet. You need either a large price correction or more time correction, where markets continues to be in a broad sideways movement and just spend time here, or it undergoes a large price correction. Which one it will be, we don't know. We don't have a crystal ball to see. Same cut for sectors. You can see very few sectors you see a median entertainment because the number of stocks are very less, only four. Therefore, four and three, these last three or four sectors, three sectors could be misnomer. They will not reflect the correct picture because number of companies are very slow, very low. You can see for rest of the sectors, it's very hard to find bargain opportunity. Financial services has one fourth, 25% stocks are in the lower 33 percentile of their valuation. So if you look at the valuation of each company, compare it to its own history, you will find bargain in some areas, financial services, consumer services, some IT companies, etc., some power companies. So this is a sector by sector cup. When you look at it from a bottom up perspective, you will find some opportunities. But broadly, as you can see in the heat map, the opportunities are not a lot. Third, we also drew a median P multiple of NSE 500 X PSUs. Why did we do PSUs? Because PSUs generally trade at a discount. So when you remove that, you will find that other stocks have a higher median P multiple, which is 40 times, one of the highest that we've ever seen. Usually, the previous peak was about 30, 34 times. This time we have gone to 40, 41 times, where multiples has to cool down a lot. Uh, I don't know whether it will come to the average or where it will settle. It is possible that our ROEs go up because asset turns improve and the multiple settles at a higher number, or if it doesn't, it can go at a lower number. But it's quite clear that 40, 42 is a very high multiple. And probably market, as I said, has to go through a time correction or a price correction to align this multiple, or it has to showcase 20% plus earnings growth and maybe higher ROEs. Then this number will get justified. But as of now, that is not happening. Third, and maybe the last point is the IT sector. And you can see that in the IT sector, there has been a large price correction of 25% or so. But what is notable is that there was a large correction in margins for these companies. So after COVID, there was a huge uptick in margins and then margins collapsed significantly. But over the last 2, 3 years, when the sector hasn't done well, margins have not deteriorated more. They have largely been in a range. They have not gone down significantly, which we think is a signal that the sector is still alive. It is going through a bad business cycle, of course, the earning growth is almost negligible. Sales growth is very, very low, but they are able to protect their margins somewhat, which tells us that once the business cycle improves, these companies will make a strong comeback. And of course, this is the sector which is now trading close to fair multiples. We believe that if it were to fall 15-20% because of some event or price correction, it will become a very good absolute bet. Maybe it is not there yet, but it is much better than the rest of the market, which is trading at expensive multiples, and the growth trajectory is not very clear. So this is the last slide which I will discuss, which tells you that if you just shift your allocation towards more quality, which means that if you shift from, let's say, large cap index to large cap quality, what it does is it just slightly improves your average odds. Your average return goes up. You can see same for large cap, mid cap, small cap. All the three same thing happens, which means that your drawdowns reduce a bit over a full cycle. It will give you a better experience and possibly better outcomes. So with this, I will stop here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.